There is a war happening right now. Oil prices are elevated. The news has been running the same loop for months: debt, conflict, inflation, crash. And somewhere in the middle of all that noise, your retirement account just went up. That is not a mistake. That is not the market being broken. That is something specific happening that nobody has sat down and explained to you. And that is exactly what we are about to do. I am Maxine. Rich Auntie knows. The Iran conflict is real. The disruption to oil supply is real. Elevated energy prices feeding into everything: food, shipping, manufacturing. That is real. And yes, the S&P 500 is trading around 7,264 as of this week, a record high in the middle of all of it. So the question is not whether the war is serious. It is. The question is why the market is not doing what everyone expects it to do. And more importantly, what that means for the money you have sitting in your 401k right now. Here is something people do not say enough. The fear of financial institutions in our community is not irrational. It has a history. Black families bought land and homes in cash for generations, not because they did not understand how banks worked, but because the bank was never going to say yes. Redlining, loan denials, institutions that took deposits and returned nothing. Your great grandmother did not keep money in a mattress because she was unsophisticated. She did it because she had already watched the institutions that were supposed to hold it prove they would not protect it. That distrust was earned, and it got passed down, which means the hesitation you feel right now when the news is loud and you are looking at your retirement account, wondering if you should pull out, some of that is yours, and some of that belongs to the generation before you that had every reason to stay outside. But here's the turn: your ancestors who bought property in cash were not avoiding wealth building. They were finding the vehicle that was available to them and using it with discipline and without permission. The Roth IRA is one of the few financial vehicles in existence where the rules are actually the same for everyone. Same contribution limit, same tax treatment, same compounding. Nobody gets a better rate because of their zip code or their credit score or their last name. And you do not need a bank to say yes. The question is no longer whether you can get in. The question is whether fear, which was built for a different era, is costing you something in this one. So let us talk about what is actually holding this market up. Because once you understand it, the war stops being a reason to panic and starts being something you can actually read. The first thing you need to understand is the Fed put. A put is financial insurance. It protects you when something loses value. The Fed put is the market's belief that if things get bad enough, the Federal Reserve will step in, cut rates, inject money, buy assets, whatever it takes to keep the floor from falling out. That belief has been reinforced every single time the market has broken since 2008. In 2008, they bailed out the banks. In 2020, they printed trillions, sent checks to people's doors, and bought bonds like there was no tomorrow. The message every time was the same: we will not let it go all the way down. So investors have learned to buy when prices drop because they believe the safety net will hold. Now, here is the tension the war creates. If oil stays elevated because of what is happening in the Middle East, inflation does not fully die. And if inflation stays high, the Fed cannot cut rates to rescue the market without making your groceries more expensive at the same time. They would be stuck. That is the real risk, not a crash tomorrow, but a Fed that loses one of its main tools. That is worth watching. It is not worth panicking about today. The second force is the one most people have never thought about. Right now, more than half of all money in US equity funds is in passive investing: index funds, ETFs, 401k accounts. Here's what that means in practice: tens of millions of people get a paycheck every 2 weeks, and a percentage of that paycheck automatically goes into a retirement account. And that account automatically buys the market. No decision, no reaction to the news, no watching what is happening in the Strait of Hormuz. It just buys every 2 weeks, rain or shine. When the conflict escalated and oil spiked, that machine kept buying. When tariff fears caused the sell off earlier in 2025, that machine kept buying. That constant automatic river of money is one of the main reasons every major sell off in the last decade has turned into a recovery within weeks. And here is what that means for you specifically. When you contribute to your 401k or your Roth IRA automatically, every single paycheck, you are not just saving, you are part of that stabilizing force. Regular people doing the boring thing, showing up every 2 weeks, are literally part of what keeps this system running during the exact moments the headlines say it should be falling apart. Now, let me tell you something about why the market has not crashed, even though it is historically expensive. There is a measure called the CAPE ratio. It looks at stock prices relative to earnings over the last 10 years, adjusted for inflation. Right now, that ratio is sitting around 39 to 40. The only time in market history it has been higher was just before the dot-com crash in 2000. Stocks are expensive by almost any historical standard. So does that mean the crash is coming? Maybe, eventually. But that number has been elevated for years, and the market kept going up because valuation alone does not cause a crash. Crashes happen when something specific breaks, when a real shock enters the system that the stabilizing forces cannot absorb. The war is a pressure. It is not yet a break. Three things would actually break it. First, bond yields. Right now, 10-year Treasury yields are hovering around 4.5 to 5%. If they push to 6 or 7%, investors would have a reason to leave stocks entirely. Why take market risk when the government pays you 6% guaranteed? That pulls real money out. Second, unemployment. The passive investing machine depends on people having jobs and contributing every paycheck. If unemployment spikes significantly, people stop contributing and start withdrawing. The machine that has been buying every 2 weeks starts selling, and selling creates more selling. Third, AI not delivering. The seven biggest companies in the S&P 500, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, make up roughly a third of the entire index as of April 2026. Most of the bullish case for those companies rests on artificial intelligence, delivering massive returns on the hundreds of billions being spent. If the market starts to question whether that payoff is coming, those stocks drop fast. And because they are such a large piece of the index, everything follows them down. None of this is a prediction, it is a map. A map is what you need right now, not a forecast. Here's what this means for what you should actually do. The single worst thing you can do during a noisy, uncertain market is make an emotional decision with money you are not going to need for 10 or 20 years. Moving to cash is not playing it safe. It is locking in your losses and guaranteeing you miss the recovery. If you miss just the 10 best days in the S&P 500 over the past 30 years, your returns would have been cut in half. 10 days out of more than 10,000. You cannot time that. Nobody can. Know what you own. Look at your 401k and find out if you are in a target date fund or an index fund. A target date fund is already designed to adjust as you get closer to retirement. You do not need to manage it manually. An index fund tracking the total market means you are already diversified across the entire US economy. That is the position to hold through uncertainty, not abandon. Keep contributing. When the market is down or uncertain, every dollar you put in is buying more shares at a lower price. That is dollar cost averaging. It works precisely because you do not try to time it. You just keep showing up. And if you have money sitting in savings you will not need for at least 5 years, understand that cash loses purchasing power every year you leave it there. Inflation, the same inflation being driven in part by elevated oil prices, is quietly reducing what that money can buy. A low cost index fund is not a gamble. It is how wealth compounds over decades. Here's the part that does not get said enough when we talk about war and markets and whether to stay in. Women hold significantly less in retirement accounts than men, not because we do not earn, but because the wage gap compounds over time. A woman earning less than a man in the same role is also contributing less to her 401k automatically. And because compounding rewards duration and amount, that gap grows wider every year it goes unaddressed. The market volatility keeping you on the sidelines right now is costing you time. And time is the one thing in this equation that cannot be recovered. At a historical average annual return of 10%, the long run historical average, not a guarantee, $1,000 invested today becomes roughly $2,600 in 10 years. Wait 3 years to start, and that same $1,000 only becomes about $1,950 in 10 years from now. The market does not care about the timing of the conflict, it cares about duration. Your ancestors who bought property in cash understood duration. They understood that the vehicle they had access to required patience, consistency, and the refusal to let fear make the decision. They built equity in land the way you can build equity in the market by staying in, showing up, and trusting the long game. The principle is the same, the account is just different. So here is what I need you to do after this video. Do not touch your retirement account out of fear. Do not move to cash because the headlines are loud. Check that you are contributing something, anything, every paycheck. If you are not investing yet, open a Roth IRA. In 2026, the contribution limit is $7,500 a year. That is $625 a month. If you are 50 or older, the catch up limit is $8,600 a year. At Fidelity, FZROX charges 0% in fees. At Vanguard, VTSAX charges 0.04%. These are the lowest cost entry points into the market. Start there. The war is real, the noise is real, and the market is still up. That is not an accident. Now you know why. If someone in your life is watching the news and thinking about pulling out, share this video with them before they do. This information belongs to all of us. I will see you in the next video. Rich Auntie knows.